Welcome, everyone. We're going to go over the One Big Beautiful Bill tax law change that we saw earlier this year and discuss how it may impact you individually and how it may impact the broader economy with respect to some items. I'm Chad Seegers, managing partner and advisor here based in Houston, and joining me is my partner, Brian Stormont in San Ramon, California. What we'll do is just kind of give you a brief overview of the law, what was made permanent and what is actually temporary. Discuss the estate tax and income tax piece that you need to consider for planning purposes, and what actually this is going to do to impact businesses and investment world. And so kind of a broad overview of the law here.
Yeah, so the law itself is pretty massive. It's an 850-page bill, roughly. It was signed into law back in July. I'm still getting data points from various tax planners as to little nooks and crannies in this thing. So I would say today's discussion, certainly is a point in time. I suspect we'll find about new, very creative ways that people might be looking to apply these new rules for their theoretical benefit. So what this does in a lot of cases, one of the main thrusts of the provision is to permanently extend the Tax Cuts and Jobs Act tax brackets, as well as the higher standard deduction. In fact, in some cases, actually increase it a little bit. So past that, there are some changes that are very important to individuals that everybody needs to be thinking about, whether it applies to them or not. And we're going to go through and take a look at a few of those. So first off, the standard deduction. So now this is made perfect, but permanent, I should say. So these standard deduction numbers really jumped up on the Tax Cuts and Jobs Act. For us residents in California, that was a nice, turn of events because a lot of the SALT deductions got phased out. So fortunately, it worked out quite well. And in fact, as we're going forward with these new rules, we're still finding a lot of people that are going to just continue to take the standard deduction because it is that attractive.
And then the other thing that was actually increased was the estate tax. And so for each individual, you now have $15 million that you have the ability that is not exposed to pay estate taxes at the time that you pass. Be the second death for a couple, which would be a $30 million exemption. Which, you're going to start indexing that for inflation starting in 2026. So vast majority of people not exposed to paying a, quote unquote, death tax or estate tax. You do still have to file a Form 706, whether or not, estate tax is due or not. And so you have to consider some careful planning. While most people are not paying an estate tax, you do have to take into consideration what money is left over at the end of the day in retirement accounts, because those rules, have shifted from a life expectancy payout to a 10-year payout. So while the state tax is not an issue, you do have planning considerations around taxes upon death. They're just different.
And just real quickly, I will say with Form 706, I'm disappointed to see that is still in the law. What that basically means is the surviving spouse is looking to utilize the unused part of the estate tax exemption for the spouse that has passed. If you don't file it properly, it can come back to haunt you in a big way, or certainly your beneficiaries. Just was a pretty notable court case that was finalized where it was ruled in favor of the IRS over the beneficiaries of an estate. Ended up costing them about, I think, almost $2 million just because the form didn't get filed. They actually filed it, they just did it wrong. So again, got to be really careful with some of the stuff, and reinforces how important some of these nooks and crannies in the law are. But moving to more, I think, positive news for certainly for us in California, the mortgage and SALT deduction, they are back. They are gone up. So in the Tax Cuts and Jobs Act, the SALT deduction got capped at $10,000. As I noted, that caused a lot of people to jump over to the standard deduction instead. Now we find that the SALT deduction is going to move back up to $40,000. Here's the key caveat, though. If your income happens to rise above $500,000, it starts to come back down, that deduction, and phases all the way back down to $10,000. Now, obviously, not everybody's making that amount of money, but since this law has come into effect, I've already run into several cases where we realized, at this point in the year, that people were, in fact, maybe going to run above that and weren't taking advantage of some deductions that they should be. And consequently, we were able to readjust and get them to stay close to that 500,000 threshold. Here's why it's so painful. two things are happening at the same time. Your income is going up above that 500 threshold and your deductions going down. So when you look at the impact of trying to keep it down, it's huge. It's something we really, really want to encourage people to be aware of.
So you got to consider, things that we do for the benefit of other institutions, charitable giving. You've got some things that still work here. You've got $1,000 per individual for above the line deduction. Itemized deductions are now subject, though, to a cap of 0.5% of adjusted gross income. And even for top earners, there's 35% of the value. Now, something that is kind of changing with respect to retirement income planning, you can still make qualified charitable distributions from your IRA. You can still start doing that directly from your IRA at 70 and a half, even though the required minimum distribution age has started at age 73 for those that are 73 before 2030, and then 75 for those after. And so there has been a disconnect between the old 70 and a half required minimum distribution rule. They have left the qualified charitable distribution rule at age 70 and a half.
And as we segue into this next slide, I think this illustrates perfectly how much some of these rules are kind of blending together in some ways. So there's a new $6,000 deduction for individuals age 65 plus. It's per spouse. You don't need to itemize or choose the standard deduction. It comes either way. The key here is that your income has to be below certain thresholds. So for single filers, it's going to be 75,000. For joint filers, it's going to be 150,000. And there is a phase out, and I found that phase out's fairly long in duration, but there's a phase out nonetheless. So one of the considerations we want to think about, because remember, these rules are only available for a couple of years. So it's years 2025 to 2028 that we can do this. So I have found in a couple of cases where we've got some people who, because of their RMDs, we're going to be getting phased out on it, but we're making charitable contributions. And so all of a sudden we're talking about, hey, maybe we should do that QCD instead to get your taxable income down, get you that $6,000 deduction. So again, got to be thinking about how all these different new provisions can start to work together for your benefit.
Another one is auto loan interest deduction. So this is a new one. It's the ability to deduct up to $10,000 of interest on new vehicle that's assembled in the US. And again, this is phased out for higher income earners, 100,000 single, 200,000 joint. And so this is going to impact a lot of people. The idea is the incentive is to buy a US assembled vehicle, give some cushion to US automakers, and sort of align people's interests along with the stability of the auto industry. And so that kind of brings us to the next phase, which is, okay, great. How does this work in the business and investment world? So we've got some deductions that were made permanent. And so you've got a 20% deduction you get for qualified business income for entities like an LLC, an S corporation. Those were made permanent moving forward. And then we went back to the old rule where you get to depreciate, expenses in year one, 100% bonus depreciation for short-lived assets. And that was made permanent rather than having to stress that out over several years, which, that tied into how companies were going to spend money for various projects. Also, domestic research and development can now be expensed immediately, in some cases actually retroactive back to prior to the law being written. And this is interesting. If we take a look at research and development as a percentage of sales this year, it's been one of the best performing investment factors year to date, even over the previous year. And we're seeing a pickup of research and development spending for a lot of companies that had it on hold. So overall, this bill really kind of took what was previously a 10-year spending bill from the previous administration, and they accelerated a lot of these dollars in the next 5 years through 2029, and change where the money was going to be allocated. And so what we went over was a lot of stuff that may pertain to you as an individual. It's going to have broader implications for the economy that are net positive near term. A little bit longer term, 2030 and beyond, there are, you have net fiscal drag from what's going on with this tax bill, but you actually get a pretty good pickup going into 2026. What's referred to as a fiscal impulse for the economy from this tax bill. So, there are implications for you as an individual and how you prepare and plan for your own tax situation, but broader implications for the overall economy as well.
Yeah, so in light of all this information, as I mentioned, we're still learning things on a week by week basis. I'm hearing new sort of interpretations in some of these rules. So I think this is a learning process overall. But a couple key takeaways in my mind. First, the phase out. So first of all, if you go above a certain threshold, in a lot of cases, it's not the end of the world. It's a phase out, and you get to participate in probably some of the deduction, but maybe not all of it. And obviously, to the degree that you can plan around it and course correct, as I've already cited, we've seen a number of instances where we were able to make some adjustments and make sure that they were going to fly below that really critical altitude that was going to allow them to maximize that deduction. Past that, again, with the estate plan, the fact that this is now made permanent, I think is actually quite good. It will be inflation adjusted going forward too, so that's really important. Charitable contributions, something we definitely want to be looking at. Business benefits, taking advantages of any changes that might be there. And finally, just with any sort of EV related or energy efficiency related purchase, I would walk, not run, or excuse me, run, not walk to the vendor you might be talking to, because a lot of those go away here very quickly. Some at the end of this month, some at the end of this year. So really want to be cognizant of the deadlines on those things. But by and large, we are finding that this tax package is leading to lower taxes for most individuals as compared to, say, 2024. So overall, it seems to be a stimulative package.
Yeah, it's been interesting, Brian, that a lot of the higher income folks are phased out of a lot of benefits from this, and so you've seen some stuff in the media that this is targeted towards the super wealthy and all that. It hasn't been the case for these individual based tax credits and how a lot of this stuff works, which is it's been pretty interesting to see. There's going to be some changes on the other side that we'll have to see from the government later on, but to be continued.
You're absolutely right, Chad. Yeah, it is near term. It is stimulative. Longer term, it does appear to add to the deficit. So, pros and cons to this for certainly. But with that said, when we think about why one would partner with Insight, as you can probably hopefully tell from today's discussion, we are extremely holistic in our approach. We look at not just the investment portfolio, that's just one small part of the person's overall financial picture, but their entire picture, including taxes, financial decision-making, benefits utilization, estate planning, risk management. I mean, you name it. These are conversations we're having on an ongoing basis. Of course, our offices are located here in Northern California in San Ramon, where I'm out of, in Houston, Texas, where Chad resides. But we work with clients all across the country. And so if you are an existing client and you know of anyone else you think might be interested in working with us, pass our name along. We always love a good introduction. Really, really appreciate that. And if this is a video that you're seeing for maybe the first time, hopefully something we've said today is cause you to make think about things a little bit differently, and maybe you want to engage in a conversation. Our initial appointments are always just very much a conversation. It's not a sales pitch. We're a fee-only firm. We're not looking to sell anything. We're just looking to bring our skills and tools to the table for our clients and their benefit. So with that said, Chad, you want to take it from here?
Yep. Thanks for the time today, and reach out with any questions you may have about the tax policy or other events that we're seeing on a higher frequency basis within the economy. Thanks.
Thanks, guys.